Welcome back to the portfolio, everyone. And today we're going over the top 5 casino stocks you can take a look at right now if you want to jump into casinos. So as the economy begins to reopen once again, casinos in Las Vegas have seen a large influx of people coming back to their casinos and attractions. So the state actually had to shut down all casinos because of the pandemic, and all casinos were shut down for around 75 days throughout the month of March and the month of April. So now that the economy has started to reopen, these Vegas casinos have been packed once again, and now may be the time to jump back into casino stocks if you're looking to add them to your portfolio before they fully recover, if they do fully recover back to pre-pandemic levels. So we're going to go over 5 casino stocks you can take a look at right now. But before we do that, we're going to jump into my portfolio just to demonstrate how my portfolio performed today. When the overall market did see a bit of a red day today, we saw a nice 2.6% drop in the S&P and a 2.7% drop in the Dow Jones. Overall portfolio value is around $43,442. On the day today, we saw a decline of close to 2%, around $760 into the red. Overall portfolio is now down around 11%, $4,757 in the red overall on this portfolio. So we're going to jump right into the top 5 stocks, but I am going to ask, can you please like and subscribe? We post daily videos about the stock market and different stocks you can invest in. And of course, we are not financial advisors. I am just here to entertain and share with you some different opinions of my personal thoughts about the stock market. So always do your own research, and we're going to jump straight into number 5. This list is not in any order, but these are just 5 casino stocks you can take a look at right now. If you believe in the future there is a lot of potential for them to recover and generate more revenues as the economy begins to reopen and travel bans get a little less restrictive and people are moving around the country a lot more, casinos may see an increase in revenue, and if they go back to pre-pandemic levels, there is potential profit to be made. Of course, with these kind of stocks, I believe they are extremely high risk, only because if for whatever reason there is another economic closure and these casinos once again have to shut their doors, I believe the stock prices could take a massive hit and may not recover back to those pre-pandemic levels. And once again, I cannot predict the future. Those are just my opinions and my thoughts. For me, I'm going to state right again, before we get into any of these top 5 stocks, I personally do not own any of these stocks. I don't plan to own any of these stocks. I'm a dividend growth investor, and of course, all these companies no longer pay a dividend. They were forced to suspend their dividends considering what happened, and they had to shut down all their operations. So these companies do not fit my investing horizon for me personally, but of course, I got a lot of requests for this video, so I'm still going to go over the top 5 stocks. We're going to go over how the price has performed for each of these companies, and we're going to take a quick look at their financial statements to determine which ones may be better than others and which ones might have better fundamentals behind them. So the first one on this list, and once again in no particular order, is ticker symbol MGM, which is MGM Resorts International, currently trading at $16.93 a share. On the 1-day chart, you can see it took a massive dive today, down over 8%. And on the 1-month chart, the stock is actually up 16%. You can see very volatile, a lot of price movements over the past month. Current market cap on this company is just over $9 billion. So with all these stocks, you want to take a look at their fundamentals. Obviously, the last quarter is not going to be very well because they were shut down completely over the last 2 to 3 months. But of course, what we are going to take a look at is the years before this pandemic. We're going to see how they operated when the casinos were operating at full capacity. Were they growing revenue year over year before this economic closure? And how are their balance sheets? Do they have enough assets? Are they strong enough balance sheets right now to maintain operations even though they may not be operating at full capacity? Can they weather this storm and continue to operate moving forward? So we're going to take a first look here at MGM and their income statement. And you can see starting from 2015, year over year, they saw nice increases in revenue. Of course, over the past trailing 12 months, we do see a decline, but that is, of course, to be expected. Their months where they were fully shut down have not been posted yet, so I'm sure we will see another further decline in revenue moving forward. But once again, we know exactly why that happened, and hopefully in the next coming weeks and months, they'll be able to solve those problems, once again reopen to full capacity and generate more and more revenue, just so that the people who do choose to invest in these stocks after they do their own research can see a nice potential return moving forward. Another thing I want to say with these stocks, we are going to take a look at their net income. But before we do that for MGM, just pay attention. Remember that these high-risk stocks, yes, there is a potential for high reward, but the high risk is guaranteed. The high reward is not guaranteed. You are not guaranteed a high reward with these stocks. You just have to make sure that you only put in money that you are okay with losing, because in my personal opinion, these are at a higher risk level compared to some other blue chip companies out there on the market. So you can see here, you want net income to follow a similar trend for revenue. We saw a nice year-over-year growth in revenue. And as you can see here, net income year-over-year is on an upward trend following the same way as revenue, which is great to see. Now we got to take a look at their balance sheet. Because we obviously understand that revenues are not coming in or did not come in for a substantial portion of the first quarter and second quarter of this year, we're going to make sure they have enough assets on hand in order to pay off all their liabilities and continue to operate and continue to fund operations. So you take a look here at their total current assets. You can see here that MGM has total current assets at around $7.6 billion. Now we're going to take a look at their total current liabilities, and their total current liabilities are only at around $2.6 billion. So their current ratio is actually close to 3, which means they have a lot of current assets to pay off all their current liabilities within the next 12 months, and they're going to have a lot of assets left over to continue to operate the business. And of course, with casinos, they are a very cash-heavy business. They have a high need to maintain a high cash level, and that is exactly what MGM has. So I do believe their balance sheet is fairly strong right now. Of course, we have to take a look at their overall balance sheet. So you can see here, $39 billion of total assets compared to total liabilities of $25 billion. So once again, a decent ratio of assets to liabilities, and I do believe they are going to be able to weather the storm over the next 12 months. The second stock we're going to take a look at here is, of course, Wynn Resorts, ticker symbol WYNN, currently trading at just over $75 a share. On the 1 month, once again, follows a very similar trend to MGM. Very volatile stock. We saw a nice little surge in price with a nice following decline. Market cap very similar to MGM once again at around $9 billion. If we take a look at their fundamentals, you can see here that revenue was growing year over year very nicely. Now, if we take a look at net income, once again, you could see the trend of growing net income. But once again, this one was a little different because over the past 3 years, even though it was pre-pandemic levels, you could see net income was actually on the decline. So it is a little bit worrisome. When we take a look at their balance sheet, you can take a look and see that total current assets are around $3.4 billion. With total current liabilities at around $1.8 billion. So they have a current ratio once close to 2. Not too bad. They do have enough assets to sustain over the next 12 months. Total assets at around $14 billion, with total liabilities at around $13.2 billion. So that is not a really good ratio. That's something that we not want to see, because even though that ratio is over 1, it is extremely close, and because we aren't kind of uncertain with how the next 12 months are going to happen, and there is a strong possibility that casinos may have to shut down moving forward, and they may not be able to operate at full capacity for the next little while, for the next 6 to 12 months. This is somewhat worrisome. They do want to be able to bump up those assets or reduce some liabilities in order to maintain operations and go smooth sailing, even with reduced capacity in their facilities. The next one we're going to take a look at today is ticker symbol LVS, Las Vegas Sands Corporation. On the 1 month chart, they are almost flat, down only 0.04%. And you can see here a very similar trend. All these casino stocks follow a similar price trend over the past month. We saw a surge followed by a nice decline. This is a very large company, the largest of the first 3 here. You can see of a $35 billion market cap. Financials, you can see year over year revenue was slowly growing, which is nice to see, with the trailing 12 months revenue is declining. Of course, we will see how the next quarter results comes out, and we'll see how much revenue does fall for all these casino companies. Next thing we're going to take a look at here is total net income. Net income was slowly growing, but it has been somewhat declining over the past few years, similar to how Wynn performed. So not great to see. You really want to see companies growing net income year over year. Seeing a decline over the past 3 years is not that great to see. Next, we're moving over to the balance sheet, and you can see here total current assets at around $3.5 billion. While total current liabilities at around $2.4 billion. So once again, their current ratio is above 1, so they do have the assets on hand to sustain short-term operations. Taking another look at total assets at around $21 billion compared to total liabilities at around $15 billion. Little decent of a total average there. That ratio is a little bit better, but of course can be bumped up for companies with a lot of uncertainty moving forward. You want to get that current ratio as high as possible. Just to maintain they have the assets on hand. If they have to shut down even further and generate less revenues, they have assets to cover all those liabilities. Number 4 on this list is casino stocks to take a look at right now is going to be Penn National Gaming, ticker symbol PENN, trading at $33.38. They saw a massive decline today, over 9% drop in a single day. But on the 1-year chart, you can see a massive surge in price. This stock has actually fully recovered back to higher than its pre-pandemic levels. You can see in the month of February, they were trading around $37 a share, dropped all the way down to $6 a share, but it has nice, fully recovered, almost back to that level, up to $33 a share. Small market cap at around $5 billion. Take a look at their fundamentals here. You can see revenue was growing nicely year over year with a very slight decline over the trailing 12 months. Net income, not the best net income trend you can see here. So as you see, net income did grow for 3 consecutive years, but followed by massive declines and then eventually a net loss over the past 12 months. Their balance sheet is not the strongest once again. Total current assets around $1.27 billion. Meanwhile, total current liabilities are around $800 million. More current assets than current liabilities, but of course that's kind of how you have to operate in the gambling sector. You have to have a lot of current assets on hand, but that current ratio could be a bit better. The last and final stock we're going to take a look at right now is CZR, Caesars Entertainment Corporation. Saw a little bit of red today, down 3.2%. Current stock is trading at just over $12 at $12.05 a share, up 25% on the 1-year charts. You can see here trading pre-pandemic levels at around $14.50. They're almost fully recovered back up to that price. Market cap at $8.52 billion. And of course, finally, we're taking a quick look at their balance sheet and income statement. You can see growing revenues year over year, which is fantastic, followed by net income that is actually terrible. And when I saw this, I was a little disgusted because this company is growing revenue nicely, but is losing money year over year. Of course, we are not taking a deep dive to figure out exactly what happened each year, but as you can see, although this company is increasing revenue, they are not increasing their net income and not following that same trend. So for me, that is a red flag. Of course, we're going to take a look at their balance sheet just to see if they're able to sustain operations over the short term. Total current assets around $3.4 billion. Meanwhile, total current liabilities around $2.8 billion. So they do have the current assets on hand to maintain those current liabilities, but of course, this balance sheet could be a bit better, same as all these casino stocks could. So I do appreciate everyone who tuned in and watched this video. I did do it because it's a highly requested video. Although I am a dividend growth investor and I personally will not be investing in any of these companies, I want to make a video talking about the top picks that I've seen in the industry, and I've did a little research into their fundamentals and shared with you what companies I believe are better than others and which stocks have stronger balance sheets and income statements compared to their peers. So I do appreciate you tuning in. I'm the Gen Z investor, and on this channel we talk about investing in stocks in daily videos. And of course, leave me a comment down below with any questions and I will always answer every single comment that I see. So I appreciate you for tuning in, and I will see you in the next one.